Hello, and thanks for joining us today for our discussion about the market outlook and especially in the current environment, thinking about how to best manage uncertainty in the current environment. We're about 6 to 7 weeks out from our normally scheduled semi-annual market update conversations that we like to do with clients on a regular basis. But we thought given everything going on in the financial environment today, the economy, headlines about changes in fiscal policy, we thought it was important to have a conversation here towards the end of the first quarter as we get closer to some potential changes and new headlines coming out on a regular basis. So joining me today, my name is Chris Graff, our Chief Investment Strategist here at Curi RMB Capital. Joining me today is Dick Burge, our Chief Investment Officer and Executive Chairman. And Dick and I will kind of walk through the conversation today, with Dick kicking it off with some comments, and then we'll turn it over to a Q&A discussion at the end that I'll help kick off as we get there. So with that, Dick, I'll turn it over to you.
All right, thank you and welcome. We do think this is a time when having conversations about the unique environment we find ourselves in really important between a firm like ours and our clients. So we're going to try to clear up a few things today, hopefully, and then in advance of this meeting, we solicited questions and had a great response. So we'll try to address all those questions today. So what I would like to do to just try to frame this, I think we have found ourselves in a unique environment from a number of perspectives. One, this idea of feeling more uncertainty about what may happen tomorrow or the next day or next week. At least for us, we feel like the uncertainty in particular right now coming out of Washington is creating an environment for investors where there's likely to be ongoing volatility and more volatility and persistent volatility than we've experienced, over the last 10 or 20 years. So that's one factor that feels different today than, let's just say, over the last few years. A second factor that we're going to talk about is we still haven't had a meaningful recession in a long time, yet we have in this country and many other countries, but in this country, we have a growing budget deficit, one that is moving to record levels. And that is a risk that we've talked about for many years. It is in a more uncertain environment, that risk needs to be considered when you're thinking about your own investment risks or your allocation, your investment policy. So those are a couple of things where the uncertainty seems highest. And then the last topic that I'm going to focus on is related to the current price of owning equities globally. And we're going to talk you through how that has impacted our forecast for long-term returns. And then we're going to tackle questions. So you can move on to the next slide, Chris. So this isn't anything new, but I think importantly, when you look at this chart and you consider the fact that from a fiscal spending standpoint and a net budget standpoint, the math, regardless of where interest rates are, even if they were to stay in the neighborhood of where they are today, we are on a path to have the deficit represent 130% or more over the next few years of GDP. So why is that important to investors? It just means that, for example, if maybe when we have the next recession, the federal government cannot be, in our opinion, as aggressive to stimulate the economy, to turn it around when we have the next recession. So that means that the recessionary environment is just a higher risk environment than it has been. That tool that the government has had in its toolbox at a minimum is going to be less effective. They can be less aggressive. Next slide, please, Chris. So that's happening, the budget deficit with the budget deficit in the background. And then you look at the price that you have to pay to own U.S. large cap stocks, for example. And this chart has broken out the top 10 components of the S&P 500. And it just says that those companies are trading at a significant premium to where they have traded historically. They're trading around 27 times earnings, while on average, they have traded since the mid-1990s at about 20 times earnings. So for those top 10 companies, there is no question to buy them today, you're paying a premium. The remaining companies in the S&P 500 are not trading at as high a price, but still at a premium from where they have traded historically. S&P 500 today is trading at around 20 times earnings and has traded in the past at between 16 and 17 times earnings. So why is this so important? When you pay a higher price than normal for a basket of high quality companies, that in turn historically has meant over a long period of time that you will earn from that point forward a lower than normal average annual return from your basket of high quality companies. So that's why it's important. And when you look at our return forecasts on the next slide, you can see, there's a lot of data here, so I'm going to spend some time on this, but you can see the return forecasts that Curi RMB Capital has just recently updated. These are 10-year forecasts for the annual return from these various asset classes. So I'm going to really focus on the middle column, the return column. So just reading from top to bottom, our forecasts for owning a high quality core fixed income portfolio for the next 10 years is a compound annual return of 4.5%. That has gone up pretty dramatically since interest rates have been rising. So that 4.5% forecasted return is not far off from the current yield or coupon that one could receive from owning high U.S. Treasury securities and high-grade corporate bonds. So that's been an improvement over where we were just a few years ago. High yield or junk bonds, our forecast is a 6% return. And I want to point out that from our perspective at Curi RMB Capital is that extra return, 6% instead of 4.5%, where you're taking more credit risk, we just don't find that a very attractive return. So we have scaled back our recommended exposures to traditional high yield. Now, when you work down this list and you get into equities, and this is where there's a lot of discussion to be had, U.S. large cap companies, we're forecasting a significant reduction in the rate of return from U.S. equities over the next 10 years compared to the return they've produced historically. So 6%. Not significantly more than you could earn owning high-grade core fixed income. And then we've broken it down between what are called value stocks and growth stocks. We think growth companies which would include the top 10 companies in the S&P, mainly technology companies, we think their rate of return is going to come in at 4.25% because you have to pay the highest premium to own them today. While many other industries, for example, financial companies, industrial companies, are considered value industries, we think the return there can be 7.75% per year over the next 10 years. And then moving down the list, U.S. small companies, we think will produce 8% returns. International small cap companies are by far the cheapest category in the global equity universe. And that is the only place where we actually raised our expected return over last year's forecast to 9% compounded. International large cap, 8.25. By the way, just pointing out that 8.25 for international large is a significant amount of additional return compared to what we expect from US large, 8.25 versus 6. And then emerging markets, 8.25. So just if I pause here for a minute and we look at just stocks and bonds, the first 2/3 of this return column, what's changed over the last, call it 12 to 24 months, the return available from high quality bonds has gone up to 4.5%. Our forecasted return for US large cap companies has gone down to 6. That's a significant change, and it needs to be part of the discussion with your advisor in terms of how you're positioned. The other thing that's changed and evolved over the last couple of years is our forecast for international companies has now moved to be higher than US companies. And there are some signs that international companies are starting to outperform, and there's some things happening in Europe that are new that could suggest an inflection point when you compare the environment for Europe, for example, versus the US. So now then, just finishing this out, when we look at real assets, which are things like commodities, real estate, infrastructure, assets that tend to be very sensitive to inflation, we expect that bucket to produce a return of around 6%. And then this category that we call absolute return, which are just hedged strategies, we expect those to produce returns in excess of large cap US stocks and in excess of what we expect from high grade fixed income. We do think that for individual clients where this could be appropriate, we think absolute return deserves some discussion and potentially a higher weighting in client portfolios, partly because it has a low correlation. This absolute return category has a low correlation to global equities, and it has a low correlation to traditional bonds. So you really do pick up a less volatile category with absolute return, and you have a competitive return without the volatility. Private equity, our return forecast has come down a little bit here to 10.75%, and private real estate 8.75%. So that's it. Just last comment on this before we get to Q&A. These are forecasts. I can assure you that when we look back 10 years from now, markets will not produce exactly these forecasted returns. And the valuation of these different categories has a significant influence on what forecasted returns are going forward. And the kinds of things that will change these forecasts, and they shouldn't change very dramatically without a very big change in valuation. So if there were a bear market at some point, and stocks became much cheaper than they are today, well, then the forecast for these equity categories would go up. If those stocks keep going up and become more and more expensive, there's a good chance that we would reduce our forecast for equity. So it's big price movements in markets that affect these forecasts, just so you know. So, Chris, I think we can move to the Q&A thing now.
Yeah, great, Dick. So we did receive a number of questions in advance as part of the registration process for the webinar today, so I appreciate that. Thanks to everyone who contributed some questions. We've been hearing a lot of similar questions in client meetings and conversations, so this covers a lot of good topics. We tried to narrow it down to the top 10 or 12 questions that we received. We reorganized them a little bit in kind of a flow of conversation around a couple of key topics. So, Dick, I'll start it off with the first question that we got was just generally and broadly speaking, what's our view of the current administration and President Trump?
Well, this is the way that we're going to pursue this question is just to acknowledge that this is not our first go around with President Trump. So I think it's fair to say that from an investor's perspective, he is going to keep us on our toes. He and his administration is going to keep us on our toes. So when we kind of opened with this idea that there's more uncertainty than we're used to, I think that's what Trump's style brings to the table. I'm not going to comment on our view regarding some of the policies that he has, other than just to say markets don't like uncertainty. And I think the correction that we've experienced this year has been partly driven by this uncertainty. We know that President Trump has announced that he is going to he's going to clarify his tariff policy on April 2nd. That's just a few days from now. Leading up to that, the market is speculating around what he's going to do. If he does something different than what the market expects today, there could be a significant move around President Trump's comments on April 2nd. And I think that kind of thing is going to continue. So if you believe that I'm right about that, then, as we get through these questions, there are going to be lots of opportunities to think about how to position yourself for ongoing volatility.
Great. A subsequent question was just related to all the recent headlines about, I believe, about the Department of Government Efficiency and cost cutting, going through different agencies in the federal government. And the question just sort of simply is, what's the future of Social Security?
Okay. Well, nobody knows, and I certainly don't know, although we do know that the math just doesn't work without significant modifications to the current program. And the math doesn't work partly because of demographics. We're living longer, and that's a good thing. So I believe that ultimately, and I would hope for these things to be discussed and debated by our government sooner than later. But I do think that there will be modifications where you start benefits at a later age, since we're living longer. People tend to be working longer. And then it could be that qualifying for Social Security could be partly dependent on need. Don't know. And then the last thing is, I'm hopeful that the money that is set aside to pay Social Security benefits can be invested differently and hopefully earn a higher return over the long term, helping to close the gap on the math. So don't know, but I do have some hope that we can make some progress on fixing the current program.
I'd chime in on that and say the only thing we've seen so far in the headlines is there's been more focus on trying to root out fraud and waste from the operations of the agency, rather than tackle any of the bigger issues that Dick described about how the math doesn't work in the future structure that could make sense longer term. The next couple questions were around trade and tariffs. Again, a lot in the headlines. We've seen yesterday the announcement of permanent tariffs on the auto industry. There's been a lot of conversation. So the general question was really, can we comment on the effect of tariffs in the short and long term?
So this is a chance to just comment about inflation too. So one of the concerns that we have, and I think broadly investors have, is are we going to have an environment where inflation is more volatile, which in turn it is a lever that creates volatility for stocks and bonds as well. Makes it harder for the Federal Reserve to do their job. And there are, again, some demographic issues that likely to contribute to a tougher fight to get inflation down to the Fed's 2% target. And that is that we do have labor shortages in this country, especially skilled labor. And when you have shortages of labor, it tends to push up wages, and that ends up being an inflationary symptom historically. Now, as it relates to tariffs, most tariffs get passed on to consumers. So at a minimum, in the short term, it is inflationary, in our opinion. It could be that tariffs contribute to inflation expectations, which the Federal Reserve, central banks around the world pay a great deal of attention to. Already, when the government takes its surveys and they release the Consumer Price Index, and the University of Michigan does its consumer confidence surveys, already we've seen inflation expectations start to rise, and we think that tariff discussions and uncertainty are contributing to consumer confidence falling. At the same time, consumers' expectations around inflation is rising. Neither of those things are good for the economy in the short term or for capital markets. So my hope with tariffs is that the administration can stick to something. We know they're going to use tariffs to, in their view, to try to fix some inequity in the global trading system. I hope that they can make some decisions and stick to it and take some of the uncertainty out. But beyond that, in the short term, for sure, it is going to get passed on to consumers and be inflationary.
One of the follow-on questions we often get after a discussion about tariffs and the potential inflation risks and the impact on the economy is just, well, what to do about it in our portfolios. And our general answer is, again, there's a lot of uncertainty. No one knows exactly how tariffs will be implemented. No one knows exactly how other countries will respond. But what we do know in a moment like this is it's a really good opportunity to lean into high-quality management teams that are managing businesses with strong competitive advantages. And they will adjust and adapt along the way as they figure out what the new rules of the road may be. So we've continued to emphasize that in terms of our portfolio construction and how clients should think about their asset allocations as well.
That's a great point. Owning, companies that are really well managed, they're going to be in a position to deal with tariffs in a more competitive way than their competitors.
The next question is really just kind of wrapping it all up. So related to all the headlines about cost cutting, layoffs, tariffs, is the economy likely headed into a recession this year or next?
So I think with consumer confidence falling, and with right now at least, there's so much uncertainty about what's going to happen tomorrow and what's going to happen with tariffs in general. We think that the economy is definitely slowed down, and whether we end up looking back 6 months from now and we end up having a mild, we could be in the beginning of a mild recession or not, don't know, but we do think right now our forecast is that we're going to remain in a slowing economy. If we were to have a recession, we think it would be mild. And this is without any unexpected events happening. An unexpected event happening today with consumer confidence so low and with investors in general worried about the level of uncertainty we're faced with, that could push us into a more meaningful recession. The key is to watch the unemployment rate, which remains very low. I think if the unemployment rate were to start to rise unexpectedly, that would be a sign that we are getting closer to a recession. The range of outcomes for the economy, and this is important when you think about how you want to be positioned, we think the range of outcomes for the economy over the next couple of years is really wide. It's possible that the economy could start to accelerate again if some of this uncertainty is lifted, and that could push up interest rates, would make the Federal Reserve's job tougher. So the range of outcomes is pretty wide.
And one following question we've usually heard there too is just related to the view about inflation and then a potential slowdown in the economy. So yes, recently the market seems to be more concerned, investors seem to be more concerned about a short-term stagflationary scenario where inflation could be rising temporarily related to tariffs, but the economy could be slowing at the same time. our response to that kind of question is really just what Dick mentioned there. It is one of a possible number of different outcomes in a wide range of scenarios, but it's not our baseline assumption in terms of thinking about how we make longer term decisions around asset allocations.
Yeah, I think, that's a good point too, Chris, that I would say that although we don't think it's the likeliest outcome, the odds of a stagflation environment have not been higher in decades. And so that's a new risk, really. And stagflation has never been good for the stock market. It's a resolvable risk over time, but it's not a good environment. So we hope we don't have a stagflation environment, let me say.
Switching gears in the line of questions, the next number of questions are really around what to do or thinking about investment decisions in the current environment. So the first one was, with the erratic daily actions by this administration, the challenges by the courts, and the questions related to tariffs, is the usual strategy of buying in the down markets still the favored approach?
Yeah. So, I'm going to back up a little bit because I think these questions are all going to come back to, a couple things. First thing is, we don't believe in market timing. We believe that every investor should have a plan. It should be written. We call them investment policy statements. Those investment policy statements set targets for how much, risk you're taking. And then, what I would add to that normal process is that when you find yourself in a more of an extreme environment, and again, I'm going to tie it back to the price that you have to pay to own investments. Extremes don't happen very often. They might happen once or twice in a decade, where you might move off of your normal investment policy targets, and they're triggered by opportunity. In other words, when we've had a bear market and stocks are really cheap, I'm using stocks as my example, you might raise your long-term target to equities because you have a chance to buy them cheap. And when you buy them cheap, your return expectation would be higher than normal. That's a great opportunity. If you're well positioned to take advantage of that, now, that would be good. We think that's important. Now, the other extreme is when stocks have gone up a lot, and we have had back-to-back 20+% years for the S&P 500. And although a lot of that's been driven by, technology companies, stocks are expensive. And so this would be a time, depending on your circumstances, to maybe scale back your long-term target in equities and maybe even scale back more in large cap growth versus other things that are cheaper, like small cap companies and international equities. So, did I get to your question in all that, Chris?
Yeah, I think that's great. Again, the question around buying in down markets, again, the answer to summarize what Dick said there is, yes, it can make sense, but in the context of the longer term investment policy and your financial plan.
Yeah, and I think behind the scenes, and Chris pointed this out earlier around the quality issue, but behind the scenes, every day, our equity team is modifying portfolios and things that happen when markets go down. Individual companies, of course, inside the market, they go down, up and down more than the other companies do. And, we're ready to buy a company in your portfolios that's a high quality company that has gone down a lot for some reason. We would view that as an opportunity to add to the position. So we're not really necessarily thinking about buying the market when it goes down. We're really thinking about how do we reposition the portfolio to own great companies at a great price. That's what our guys are doing, our guys and gals that work on the investment teams, both on the stock and the bond teams.
Now, speaking of bonds, the next question is a really good, kind of simple but loaded question. How safe really are the safe investments?
Mm-hmm. Yeah. Well, I'm glad somebody's asking that question. The core fixed income portfolios that Curi RMB Capital manages has always been viewed as a safety net for our clients. And what I mean by that is, although we could earn a little more return if we took a little more credit risk in the portfolio, and I'm talking about over the last 20 years, this has been consistent. And we could take a little more interest rate risk if we bought longer term bonds. We just don't do that. And so the portfolio of any of our core fixed income strategies owns higher quality than normal, but always owns high quality companies. So that means that the percentage of the portfolio that is invested in relatively short-term U.S. Treasury bonds has never been higher. And that's because you don't get compensated well for taking credit risk. And then the second part of answering Chris's question is we have also shortened the duration or the average maturity of the bonds in the portfolio so that you're protected from an increase in interest rates affecting the portfolio. Both those things have already happened, and you can count on that portfolio to be safe, always. Did I answer that question completely, Chris?
Yeah, one follow-on question we typically get too is just about the federal government, right? So if we go through, which we should be expecting sometime in April, congressional debate around legislation related to funding the government, the extension of tax policy, other initiatives. We've seen in the past, especially back in 2011, moments where there's a lot of additional volatility in the markets related to, let's call it the so-called debt ceiling. So I think the implication for the question is just how safe are Treasury bonds? Can we still count on the U.S. government to meet its obligations?
The answer is yes. And, that I'm not saying that could never change. And we are concerned about the government, not taking seriously enough being the reserve currency for the world, having a AAA, getting back to having a AAA credit rating. We think those things are very important. So I don't want to dismiss the importance of that. But in terms of the credit quality of the U.S. Government in the shorter term, meaning in the next 4 or 5 years, we're not concerned about the government defaulting in the next 4 or 5 years and hopefully ever.
Next question is back to sort of your discussion around long-term return assumptions, but how do you minimize risk and still get a 5% plus return?
Well, that's one of the things that's changed. So if you think about really simplifying your choices, stocks, let's just, to make it even simpler, U.S. stocks versus, high quality U.S. stocks versus high quality U.S. bonds. Up just a couple of years ago, and for many years, the U.S. High quality bond portfolio produced an expected return of only 2, maybe 3%, below inflation. So on real terms, you were losing money. Not a great proposition. And the return expectations for equities, 2 or 3 years ago, were more like their historical returns of between 7 and 10%. So now what's happened is, our forecasts are for U.S. large to produce a 6% return, and for high quality U.S. bonds to produce a 4.5% return. So, you just can think of that as competition for equities because people, especially an older person, but somebody, regardless of age, might say, well, if I'm only likely to get an extra percentage point or 1.5 over owning, a high quality bond portfolio, do I really want to own as much stock? So we think, if you just think about supply and demand, we think this environment, there's more demand for high quality bonds, net, for the average person, and less for high quality equities. We think it is one of the things that is maybe helping or making it harder for the market to go up over the long term. Now, as far as, how can you earn a safe 5% return? Well, you can do that. You can get closer to that by owning high quality bonds. We don't know what's going to happen with inflation. We do think equities should always have an important place in your portfolio, regardless of your timeline. And again, remember, we don't know what's going to happen with equities. Stick to high quality, especially in this environment, and you should expect to earn a return in excess of 5% in a diversified portfolio of high quality stocks and bonds.
Next question is related to gold. So should some of our portfolio include gold instead of bonds as a stabilizing item?
Yeah, well, of course, we're getting that question a lot more with gold, almost every day making a new all-time high. And I mention that because, although gold could have a role in your portfolio, historically, we have not included gold. There are other ways to, for example, hedge against inflation. We have this real return bucket that does a real good job of protecting clients over inflation. And, high quality equities are a natural inflation hedge. Well-managed companies are able to raise prices over time in line or in excess of inflation. It just might take a few years for equities to, catch up to inflation. Gold has really performed well when there's been an unexpected crisis. So one of the reasons why I think gold has been rising so much recently, one of the reasons, there are two or three factors that have contributed, but one of them is all this uncertainty. People are worried that something unexpected could happen, either because of the geopolitical environment or because of maybe a financial crisis that could be related to global trade, tariffs, that kind of thing. So I do think that that's contributing. And then other governments have been the demand for gold. Central banks in other countries have been increasing their demand for gold, I think partly because of trade and currency uncertainty. Now, as far as whether you should have gold in your portfolio, I really think that should be more of an individual decision. If you feel like the odds of a crisis of some kind are uncomfortably high for you, then we can facilitate getting you gold exposure in your portfolio. I think that would be a topic to raise with your advisor, and they can facilitate an answer for you.
One more investment-specific question. What do we recommend regarding a percentage of our portfolios that should be invested in international stocks?
Well, Chris, I might need some help from you on this, but before Chris can clarify the specific answer, what I would tell you is that today the cheapest bucket of equities in the global equity universe is international small cap companies. And there have been good reasons for why they've underperformed over the last 5 to 10 years, and why international in general has underperformed. The U.S. economy and U.S. companies have just executed much better than most of the rest of the world. With that, knowing that, the reality is valuation, the current price you have to pay to own U.S. equities versus international, reflects our better performance. And we think the difference between what you have to pay for high quality U.S. Versus high quality international is wide enough now where we think you really do need to have a strong allocation to international equities. There are great companies domiciled overseas. There is change taking place, just like we have had change in the U.S. Some of those similar changes are taking place in other countries. You recently have seen Germany announce a $1 trillion investment in defense. They have no budget deficit. So they're in a position where things can change for the better for their economy. And we think there's a good chance that that's underway. As far as the percentage goes, Chris, help me with that. I don't remember the exact percentage recommendation.
Yeah, it generally speaking, as a percentage of someone's equity allocation, we've been within the range of 20 to 25%, which is roughly in line with the weight of international companies in the global equity universe. So we've been roughly, let's call it in line or neutral, so to speak, but with a bullish longer term outlook. And as Dick mentioned, there are some really positive fiscal catalysts potentially that could help stimulate closing some of the valuation gap from international stocks relative to the US. And we're keeping an eye on that. The big concern related to international exposure has been the strength of the dollar as it relates to tariffs. And there's going to be plenty of volatility in that over the next couple months and quarters, but that may ultimately move in the direction of international stocks as well.
Don't give up on international equities is part of the message. They've underperformed, but you want to buy things low, and you can buy them lower.
Okay, in the home stretch here, two last questions. First, in the last 2 years, as we gauge the market opportunities, what was the biggest mistake that we made?
I think, again, with this benefit of hindsight, we would not have predicted the great performance that we've experienced in the U.S. equity market, the S&P 500, for example. So maybe we were positioned a little more conservatively because we didn't feel it was appropriate, frankly, to take the risk to overweight U.S. equities, but they went ahead and performed much better than we expected. So in hindsight, we could have been positioned a little more aggressively. Don't regret it because we still feel like downside versus upside is really important to our clients. And we think there was plenty of risk last year going into the year.
And I would just chip in on that too, just in terms of the economic outlook. 2 years ago in particular, there were a lot of signs that the economy was slowing and weakening. Some of the traditional indicators were suggesting the odds of recession were higher. But what proved to be the case is that the consumer stayed stronger for longer than we expected. And that was a good thing in terms of the strength of consumer savings and consumer spendings. With that hindsight, though, we can say today that the consumer is in it's not in as good a shape as it was a couple of years ago. So their consumers are in a little bit more of a stretched position today, facing a lot of the uncertainty in the current environment.
Yes.
Okay, just to wrap it up then with the last question, what are the top 2 or 3 things we should be doing in this current environment?
Okay, well, I think the most important thing to do is be prepared to weather whatever volatility or storms we're faced with your investment allocation. And I think if you're one that wants to be set up to be opportunistic, make sure you have assets set aside in something safe and liquid, and that you have a plan, to step up to the plate when a drawdown takes place. You know what you're going to do in advance so that you're ready to act and take advantage of it. And for long-term investors, that's exciting. And we do believe our clients should be pretty darn well positioned to be opportunistic, and that's happening inside the individual portfolios. But I think it can be taken to another level if, in fact, we have a bear market at some point. So anyway, I'd be positioned really well for that. I'd make sure that your cash flow needs take into consideration these return forecasts that Chris and I covered earlier. And I would remain diversified and stick to your plan. Don't get caught up in the emotions of the announcements coming out of Washington. It won't do you good to try to react emotionally. Just have a plan, work it out with your advisor, and hopefully you can be really opportunistic when volatility comes. So thank you for joining us today. This is a little different format than we've done in the past, shorter, more Q&A focused. We'll look forward to your feedback on this format. Thank you very much.
Thanks, everyone.